Friends, thank you for being here today. What if I told you that the price of something isn't rising because people want it, but because the entire world has simply run out of it, not in some distant future, not as a theoretical possibility, but right now, in real time, as factories across the globe scramble desperately to find even a single ounce of a metal that our entire civilization depends upon. In early December 2025, silver prices went vertical. In India, the price smashed through 1 lakh 84,000 rupees per kilogram. In global markets, we touched $60 per ounce. These are not just record highs. These are the kind of numbers that make traders check their screens twice, wondering if there's been a system error. But here's where the story becomes truly extraordinary, where it defies everything you think you know about how markets work. Usually, when an asset hits record prices, buyers vanish, demand collapses, people take their profits and walk away. That's the basic rhythm of every market cycle you've ever witnessed. But this time, the exact opposite happened. In India alone, in a single week, 100 tons of old family silver, jewelry passed down through generations, silverware that sat in homes for decades, was sold back to dealers, 100 tons in 7 days. Let me give you the scale of what that means. That is not normal market activity. That is panic. But here's the twist that should make your blood run cold. These dealers weren't buying this silver because they wanted to resell it to investors. They were buying it because they had no other choice. The factories, the industrial users, the manufacturers who need silver to function, they were calling, begging, offering premiums, desperate for any physical metal they could get their hands on. The dealers were melting down grandma's silverware just to fulfill orders. The mines have failed. The scrap market has become the last line of defense in a system that is coming apart at the seams. Now, let me hit you with a number that should create what I call cognitive overwhelm. 5 consecutive years. Since 2021, the silver market has been in structural deficit. That means for 5 straight years, we haven't produced enough silver to meet global demand. Not for 1 year, which might be dismissed as an anomaly, not for 2 years, which might be called a correction, but 5 years of persistent deepening shortage. Between 2021 and 2025, the cumulative deficit is approximately 800 million ounces. That is nearly an entire year's worth of global mine production that simply does not exist anymore. We burned through the stockpiles that took decades to accumulate. We drained the vaults, and now we are burning the furniture, melting down family heirlooms, stripping the system of every last ounce just to keep the machine running for 1 more month. This is not a market correction. This is not a cyclical downturn. This is a structural fault line. This is a mathematical endgame. And the question you should be asking yourself right now is not whether this breaks, but when and what you will do when it does. Let me introduce you to a technical term that most people have never heard of, but which tells you everything you need to know about what's happening right now. Backwardation. In October and December 2025, the silver market flipped into backwardation. Now, what does that mean? In a normal, healthy commodity market, the price for immediate delivery, what we call the spot price, is lower than the price for delivery in the future's price. This makes intuitive sense. You pay a premium for the convenience of waiting, for storage, for the time value of money. But when a market goes into backwardation, that relationship inverts. The spot price, the price for metal right now, becomes higher than the future's price, the price for metal later. This never happens in a healthy market. Never. It is a screaming signal that industrial users are terrified they won't get metal next month. So they are bidding up the price for immediate delivery. They are paying a premium to get the metal now because they don't believe it will be available later. This is not speculation. This is survival. Now, To understand how we arrived at this moment, we need to go back, not to last month's news cycle, not to last year's headlines, but to the genesis of this crisis. Because what we're witnessing today is not a sudden shock, it is the final act of a tragedy that has been building for years. In October 2025, just months before this vertical price spike, something extraordinary happened in Shanghai. The silver inventories, the physical metals sitting in Chinese vaults, plummeted to 10-year lows. China, the world's factory, the nation that manufactures more goods than any other country on earth, ran out of silver. They were forced to export 660 tons to London and COMEX, the Western exchanges, just to prevent a default in the global pricing mechanism. Let that sink in for a moment. The world's largest manufacturer cannibalized its own reserves, stripped its own vaults to keep the global market alive for a few more months. This wasn't a strategic decision. This was triage. This was the system gasping for air. Now, here's the mechanism that makes this crisis unsolvable. And this is what I call the black box revelation. Think of silver mining for a moment. You might assume that when the price of silver goes up, miners simply dig more. Supply increases to meet demand. That's how markets are supposed to work, right? That's the simple logic of economics you learned in school. But the simple logic does not apply here. 70% of silver is mined as a byproduct of zinc, lead, and copper mines. It's not the primary target. It comes out of the ground alongside other metals, which means even if silver goes to $100 per ounce, even if it doubles or triples from here, miners won't dig more zinc just to get the silver. The supply is mathematically locked regardless of price. The price signal, the mechanism that is supposed to balance supply and demand in a free market, is broken. This is what I call inelastic supply. You cannot simply turn up a silver mine. The geology doesn't work that way. The economics don't work that way. We are trapped in a system where demand is exploding and supply cannot respond. And this leads us to the system's most crucial secret, which we must explore now, because it explains why this isn't just about investors or traders or speculators. Everyone wants to blame the price rise on investment demand, on people buying silver bars and coins, but that is not where the real pressure is coming from. The real pressure is coming from something that most people think of as virtuous, as necessary, as the future: the Green New Deal. Solar panels now consume approximately 20% of all silver demand globally. A decade ago, that number was 5%. The exponential growth of solar energy, driven by government subsidies, climate targets, and the urgent need to transition away from fossil fuels, has created an unprecedented surge in industrial silver demand. Every single solar panel requires silver. The photovoltaic cells that convert sunlight into electricity rely on silver's unique conductivity properties. There is no substitute that works as efficiently. And as the world races to install terawatt after terawatt of solar capacity, we are literally mining the earth dry of the one metal that makes it all possible. To save the planet, we have to consume the planet. The Green Revolution is actually a resource war, and it's a war we cannot win because the ammunition, the silver, is running out. Now think about what this means for a moment. The factories building solar panels cannot stop. They are locked into government contracts, climate commitments, supply chains that have already been financed. They are price inelastic. They need the silver to function regardless of cost. If silver goes to $80, $100, $150 per ounce, they will pay it because the alternative is shutting down the entire operation. And here's where the situation becomes truly dire. Defense demand, the missiles, the electronics, the advanced weapon systems that every military on Earth is racing to build, they also require silver. We are entering a phase where the war machine and the green energy sector are fighting over the same shrinking pie. This is the convergence. This is the structural break. And this is why what happened in India, those 100 tons of family silver sold in a single week, is not just a data point, it is a warning. It is the system showing you in real time that the physical metal is gone, and the scramble to find any source, any scrap, any old jewelry that can be melted down has already begun. Friends, we are 15 minutes into this conversation, and I've given you the foundation, the history, the mechanism, the forces that are colliding. But now we need to talk about what happened in December 2025, the specific trigger event that sent this situation into crisis mode, and why the actions taken by desperate dealers in India are just the beginning of a much larger unraveling. Now, let me take you to the exact moment when the system broke, December 3rd and 4th, 2025, two simultaneous events that created what I call the double break. The Indian rupee crossed 90 against the dollar. At the same moment, silver crossed 1.84 lakh rupees per kilogram. These two breaks, happening in tandem, triggered a chain reaction that revealed just how fragile this entire edifice actually is. Think about what this means for an ordinary family in India. You're watching your currency collapse. You're watching the rupee, which represents your savings, your purchasing power, your ability to feed your family, lose value against the dollar day after day. And simultaneously, you're watching silver, this physical metal that your grandparents stored as wealth, skyrocket in price. You're faced with an impossible choice. Do you hold the metal and hope the price keeps rising? Or do you sell now, convert to rupees that are collapsing just to pay for food, for rent, for survival? What happened was both. Some families sold because they were desperate. Inflation had eaten away at their ability to afford basic necessities, and that silver, which had sat in their homes for generations, became the only lifeline they had. But others sold for a different reason. The dealers were offering premiums, substantial premiums above the spot price. They were so desperate for physical metal that they were paying extra, begging people to bring in their old jewelry, their silverware, anything they could melt down. And the reason they were doing this should terrify you. The industrial orders were piling up. The factories that manufacture electronics, that build solar panels, that produce components for everything from smartphones to missile guidance systems, they were calling these dealers, offering to pay whatever it took to secure supply because their own supply chains had broken. The normal channels, the refineries, the mining companies, the wholesalers they had relied on for decades were coming up empty. The cupboard was bare. This is what a liquidity panic looks like in the physical commodity world. It's not like a stock market crash where numbers on a screen go down. It's grandmothers bringing in their wedding jewelry. It's families making desperate calculations about whether they can afford to keep heirlooms or whether they need to eat. It's a chaotic transfer of wealth happening in real time in shops and dealer offices across an entire subcontinent. Now, let me give you three canaries in the coal mine, three specific pieces of forensic evidence that prove this rot is not isolated to India, not limited to one market or one moment in time, but is spreading through the entire global system. Canary number one, the lease rate spike. Now, most people don't know what a silver lease rate is, and frankly, most people don't need to, but let me explain it simply. Banks and large institutions that hold physical silver sometimes lease it out to industrial users or traders. Think of it like renting out an apartment. You still own the silver, but someone else uses it temporarily and pays you a fee. Normally, those fees, those lease rates, run between 1% and 3% annually. It's a boring, stable market. In late 2025, those rates spiked. And when I say spiked, I mean they surged to levels that indicated something fundamental had changed. Why would lease rates spike? Because no one wants to let go of their physical bars. The institutions that own silver, the banks, the vaults, the custodians, They suddenly became terrified of lending it out. Why? Because they're not confident they'll get it back. They're worried that if they lease silver today and the borrower needs to return it in 6 months, there won't be any physical metal available in the market to replace it. The fear of a squeeze, of a default, of a situation where someone demands their silver back and it simply doesn't exist. That fear has entered the system. This is not speculation on my part. This is what lease rates tell you. They are a price signal. And right now, that signal is screaming. Canary number two, the ETF illusion. Silver exchange traded funds, the paper instruments that allow investors to gain exposure to silver without holding physical metal, they returned over 100% year to date in 2025. If you owned a silver ETF at the beginning of last year, you more than doubled your money. On paper, this looks like a massive success story. Everyone who bought into silver through these convenient financial products became much wealthier. But this paper wealth masks a dangerous reality. These ETFs are supposed to be backed by physical silver. The prospectus, the legal documents, they all claim that for every share you own, there are ounces of silver sitting in a vault somewhere with your name on them. But what happens if all those ETF holders, or even a meaningful percentage of them, decide they want physical delivery? What happens if they say, I don't want the paper anymore, I want the actual metal? The vaults would be empty, or more accurately, they would run out within days, because the amount of paper silver, the claims on silver that exist in the financial system, vastly exceeds the amount of physical silver that actually exists in vaults. This is what we call the paper to physical divergence. And for years, people like me have been warning about it. We've been saying that one day the paper market and the physical market would break apart. That one day people would realize that owning a claim on silver is not the same thing as owning silver. That day has arrived. The 100 tons sold in India, the backwardation in the futures market, the lease rate spikes, these are all symptoms of the same disease. The physical metal is vanishing and the paper promises cannot be fulfilled. Canary number three, the strategic shift. For decades, silver demand was relatively straightforward. Industrial uses like photography, electronics, jewelry, coins, the categories were well understood and the supply chain was stable. But in recent years, something fundamental has changed. Defense demand has surged. Modern weapons systems, the missiles, the drones, the advanced electronics that every military is racing to develop, they require silver. The conductivity, the reliability, the performance characteristics of silver make it irreplaceable in these applications. At the same time, solar demand has exploded. I mentioned earlier that solar panels now consume 20% of global silver demand. But let me give you a sense of where this is going. Global solar installations are projected to continue growing exponentially. Every climate accord, every net zero commitment, every government subsidy program is pushing more solar panels onto roofs and into fields. And every single one of those panels needs silver. So now we have the war machine and the green energy sector competing for the same shrinking resource. And here's the trap. Neither side can back down. The militaries cannot stop developing weapon systems because of geopolitical competition. China is building, the United States is building, Russia is building, and everyone else is scrambling to keep up. The solar industry cannot stop building panels because of climate commitments and government mandates. They are both locked in. This is what I mean by the no escape encirclement. If the price of silver rises, these industrial users cannot stop buying. They are price inelastic. They need the metal to function. They will pay whatever it costs because the alternative is shutting down operations, breaking contracts, failing to meet strategic objectives. If the price of silver crashes, which seems almost impossible given the shortage, but hypothetically, if it did, the mines would shut down. The marginal mines, the ones that are barely profitable even at high prices, they would close. And that would worsen the deficit even further. We are trapped. The system is trapped. And the physical break that occurred in India is just the beginning. Now, let me explain something that most people misunderstand about commodity markets. There's a concept called thrifting. The idea is simple. When a commodity becomes expensive, industries find ways to use less of it. They engineer around the problem. They substitute, they innovate. And for years, the solar industry has been trying to do exactly this with silver. They've been working on technologies that use less silver per panel, that improve the efficiency of the photovoltaic cells so you can get the same power output with fewer grams of metal. And they've had some success. The amount of silver used per watt of solar capacity has declined over the past decade. But here's the problem. The reduction in silver intensity per panel has been completely overwhelmed by the increase in the number of panels being installed. Think of it like trying to bail water out of a sinking boat with a smaller bucket while someone else is drilling more holes in the hull. Yes, you're using less silver per panel, but you're building so many more panels that total silver demand keeps rising. The thrifting has failed. The innovation has failed. And the reason it has failed is because silver's unique properties, its conductivity, its durability, its performance characteristics cannot be replicated by other materials at the scale and cost required. There is no magic substitute waiting in the wings. There is no technological breakthrough that will suddenly make silver unnecessary. We are stuck with the physics and chemistry of the periodic table. And this brings us to a location that most people have never heard of, but which has become ground zero for this crisis: Loco London. This is the term used in the industry to refer to silver physically located in London vaults. London is the hub, the center of the global physical silver market. When industrial users need to source large quantities of metal, when institutional investors want to take delivery, when the spot price is being determined, it all comes back to what's happening in London. And what's happening in London right now is a shortage. The premiums for metal delivered in London have spiked. The spreads between paper prices and physical prices have widened. The arbitrage opportunities that should exist in a normal market where traders can buy in one location and sell in another and make money on the difference, those arbitrages have broken down because there's simply not enough metal to move around. When China had to export 660 tons to COMEX and London, they weren't doing it out of generosity. They were doing it because the Western markets were on the verge of default. A default in the silver market would mean that someone who bought a futures contract, someone who had a legal claim to receive silver at a certain price on a certain date, would be told, sorry, we don't have it, here's cash instead. That would destroy confidence in the entire commodity pricing system. It would reveal that the emperor has no clothes. China prevented that default temporarily by draining its own reserves. But now China's reserves are depleted. Shanghai inventories are at 10-year lows. And the question everyone should be asking is, where does the metal come from next time? When the next wave of contracts comes due, when the next surge of industrial demand hits, when the next crisis emerges, who has the physical silver to bail out the system? The answer is no one. The scrap frenzy in India, those 100 tons, that was a preview. That was the system showing you what happens when the mines fail and the vaults are empty. You start melting down family jewelry. You start scraping together every last ounce from every dusty corner. You start paying premiums that would have seemed insane just months ago, because the alternative is admitting that the metal simply doesn't exist. Friends, let me give you a framework for understanding what happens next. We are moving from what I call a price market to an availability market. For decades, the question with silver was always, how much does it cost? You could argue about whether it was overvalued or undervalued, whether it should be $15 or $30 or $50 per ounce. But the underlying assumption was always that if you wanted silver, you could get it. You just had to pay the market price. That assumption is dying. In 2026 and beyond, the question won't be how much does silver cost? The question will be, can you actually get it? Can you find a dealer who has physical metal? Can you take delivery without waiting months? Can you secure supply for your factory, for your manufacturing line, for your strategic operations? Price becomes almost irrelevant when availability is the constraint. This is what I mean by unobtainium. We are approaching a scenario where silver becomes effectively unavailable at any price for extended periods, not because there isn't demand, not because people don't want to buy it, but because the physical metal has been consumed, used up, embedded into solar panels and missiles and electronics that will not return to the market for decades. The geology of silver mining tells us something crucial. Ore grades are falling. In the 1990s, miners could extract 150 grams of silver per ton of ore. Today, that number has fallen below 100 grams per ton. This means miners have to move more rock, process more material, consume more energy just to get the same amount of silver. The easy deposits have been exhausted. What remains is lower grade, harder to access, more expensive to extract. And remember, 70% of silver is a byproduct. So even if silver prices rise dramatically, even if they triple from here, it won't necessarily bring a flood of new supply onto the market, because the mining companies are making their decisions based on the economics of zinc, lead, and copper. Silver is almost incidental. It's a nice bonus, but it's not driving the investment decisions. This is the trap. Demand is exponential. Artificial intelligence data centers require silver. 5G networks require silver. Electric vehicles require more silver than traditional cars. The entire technological infrastructure of the future is silver intensive. And at the same time, supply is inelastic and declining. The gap between these two forces is widening every single day. Now, let me bring this all together and show you why this matters for your life, for your wealth, for the decisions you need to make in the coming months. Because we are facing what I call the trifecta, three distinct forces that are hitting at exactly the same moment, creating a convergence that the system cannot withstand. Force number one, depleting mines. I've already explained the falling ore grades, the inelastic supply, the fact that 70% of silver comes as a byproduct. But let me add another layer to this. The mining industry globally is underinvested. For the past decade, after the commodity crash of 2014 and 2015, mining companies pulled back on exploration, on development, on new projects. They were burned. They had spent billions developing mines when prices were high and then got crushed when prices collapsed. So they became conservative. They focused on returning cash to shareholders rather than investing in future supply. What this means is that even if silver prices stay elevated for years, even if the market is screaming for more supply, there aren't new mines waiting to come online. The development timeline for a major mining project is 7 to 10 years from discovery to production. We needed to start building these mines 5 years ago. We didn't. And now we're facing the consequences. The pipeline is empty. The depleting mines that are currently producing, they're extracting lower grade ore every year. The new mines that should be replacing them don't exist yet. This is a mathematical reality. This is not a prediction or a forecast. This is the structural deficit that has already baked into the system for the next 5 to 10 years. Force number two, exponential demand. And I want to be very specific about where this demand is coming from because it's not what most people think. Yes, investment demand matters. Yes, people buying coins and bars creates pressure. But that's not the driver. The driver is industrial consumption that cannot be turned off. Let's start with solar. The International Energy Agency projects that global solar capacity needs to triple by 2030 to meet climate goals. Triple. That means 3 times as many panels, 3 times as much silver consumption in just 5 years. Now, the industry will tell you they're working on reducing silver content per panel. They'll tell you about new technologies, about alternatives. But as I explained, thrifting has failed to keep pace with volume growth. And even if they successfully cut silver usage per panel in half, which would be an extraordinary achievement, you're still looking at a 50% increase in total silver demand from solar alone. Then there's 5G. Every cell tower, every base station, every piece of infrastructure required to roll out 5G networks globally requires silver. The connections, the circuit boards, the switches, and 5G is not optional. It's being mandated by governments, driven by telecommunications companies, embedded into national security strategies. Then there's artificial intelligence. The data centers that power AI, the chips, the servers, the cooling systems, they consume silver. And AI is growing exponentially. Every major technology company is pouring hundreds of billions of dollars into AI infrastructure. Every government is racing to build sovereign AI capabilities. This is not slowing down, this is accelerating. And then there's defense. I mentioned this earlier, but let me be more specific. A single Tomahawk missile contains approximately half an ounce of silver. Doesn't sound like much, does it? But multiply that by the thousands of missiles being manufactured every year. Add in the drones, the electronic warfare systems, the guidance systems, the communications equipment. Modern warfare is silver intensive. And every military on earth is expanding, modernizing, preparing for conflicts they hope never come, but believe are inevitable. These 4 categories alone, solar, 5G, AI, and defense, represent an exponential curve of silver demand, and none of them can stop. They're all locked in by government mandates, strategic imperatives, technological necessity, and massive capital investments that have already been made. Force number 3, currency debasement. And this is where we connect back to what happened in India in December. The rupee crossing 90 against the dollar was not an isolated event. It was part of a global pattern of currency debasement that is accelerating. Every major central bank in the world is trapped. They have accumulated staggering levels of government debt. They have made promises, pensions, healthcare, social programs that cannot be funded with tax revenue alone. So they print, they expand the money supply, they debase the currency. And when your currency is being debased, when the purchasing power of your cash is eroding, you start looking for alternatives. You start looking for assets that cannot be printed. You start looking for stores of value that have existed for thousands of years, that governments cannot create out of thin air. You start looking for gold and silver. The Indian families who sold their silver were not making an investment decision. They were making a survival decision. But the industrial buyers who were desperately trying to acquire that silver, paying premiums, melting down jewelry to fulfill factory orders, they were revealing something profound. Physical silver has become the only liquidity that matters when the crunch hits. Not paper promises, not ETF shares, not futures contracts, physical metal. This is the convergence, depleting supply, exponential demand, currency collapse, 3 forces hitting simultaneously. And the system, this rickety structure that has been held together with paper and promises and the assumption that physical shortages could never really happen, that system is crumbling. Now, let me talk about something that most people don't want to hear, but that you need to understand. Human beings are hardwired to believe that tomorrow will look like yesterday. This is called normalcy bias. It's a psychological defense mechanism. Your brain doesn't want to accept that the world could fundamentally change, that the assumptions you've lived with your entire life could be wrong. So you dismiss warnings. You rationalize away evidence. You tell yourself that somehow things will work out because they always have before. But history does not care about your psychological comfort. History is littered with societies that refused to see the warning signs until it was too late. The Roman citizens who kept using debased coins even as the empire collapsed around them. The Weimar Germans who couldn't believe their currency would become worthless until they were using it as wallpaper. The Zimbabweans, the Venezuelans, the list goes on and on. People who experienced normalcy bias right up until the moment the system broke. And here's what you need to understand: the 100 tons of silver sold in India in a single week, that wasn't normalcy. That was panic. That was a break in the pattern. That was the system showing you in real time that we have entered a new phase. The backwardation in the futures market, that wasn't normal. Lease rates spiking, that wasn't normal. China draining its reserves to prevent a Western market default, that wasn't normal. These are not fluctuations within a stable system. These are symptoms of a system that is fundamentally broken. And the longer you cling to normalcy bias, the longer you tell yourself that this is just another cycle, just another volatility spike that will pass, the less time you have to prepare for what's coming. Let me introduce you to another concept: the money illusion. This is when you become wealthier on paper, your account balance goes up, your net worth increases, but you become poorer in real terms. Your ability to buy food, to pay for energy, to maintain your standard of living actually declines even as the numbers in your bank account get bigger. This is what's happening right now across the world. People look at their retirement accounts, their stock portfolios, their home values, and they see big numbers. They feel wealthy. But then they go to the grocery store and realize their purchasing power has collapsed. They became millionaires on paper, but they're poorer at the grocery store. The money illusion is the gap between nominal wealth and real wealth. And that gap is widening every single day. Silver, physical silver, is one of the few assets that cuts through the money illusion because it's not a promise. It's not a claim on something else. It's not dependent on a counterparty or a government or a financial system remaining solvent. It's a physical element with unique properties that the world needs and cannot create. When you hold an ounce of silver in your hand, that ounce will always be an ounce. It cannot be debased. It cannot be printed into existence. It simply is. And this brings us to the binary choice you need to make. Do you own assets or do you own claims on assets? Do you hold physical metal or do you hold paper promises? Do you have gold and silver in your possession or do you have stocks and ETFs and bonds that depend on a functioning financial system? I'm not telling you to sell everything and buy silver. I'm not giving you investment advice. What I'm doing is laying out the structural reality of the situation and asking you to think critically about the difference between what you think you own and what you actually own. When those 100 tons of silver were sold in India, the people who held physical metal had options. They could sell if they needed to. They could hold if they wanted to. They had agency. The people who held paper silver, the ETF shares, the futures contracts, they were entirely dependent on the system functioning, on the counterparties being solvent, on physical delivery being available if they ever decided they wanted it. The scramble for physical metal that we witnessed in India is coming to other markets. It's coming to other countries. The backwardation, the lease rate spikes, the premium explosions, these are all canaries singing the same song. Physical is diverging from paper. The claims vastly exceed the metal. And when enough people figure this out, when enough industrial users panic, when enough investors demand delivery, the entire structure implodes. Let me give you a framework for thinking about this. We are transitioning from what I call the illusion to the reality. The illusion is paper wealth, it's account balances, it's the belief that you can always convert your financial assets into real goods when you need them. The reality is hard assets, it's physical commodities, it's things that exist in the world that cannot be created by decree, that have intrinsic utility. For decades, the illusion has been enough. You could live your entire life holding paper and never face a moment where that paper failed to convert into reality. But we are entering a period where that conversion mechanism is breaking down, where the gap between paper promises and physical availability is becoming too large to ignore. Silver is the leading edge of this break. It's happening in silver first because silver is small, because the market is tight, because the industrial demand is inelastic. But the same forces, the same convergence of depleting supply and exponential demand and currency debasement, they exist in other markets too. This is not just a silver story. This is a story about the fundamental structure of our financial system and what happens when that structure encounters physical limits. History favors the prepared. That's not a cliche, it's a mathematical reality. The people who recognized what was happening in Weimar Germany in 1922, before the hyperinflation really took off, they prepared. They moved their wealth into hard assets. They survived. The people who clung to normalcy bias, who believed the government's assurances, who kept their savings in marks, they were destroyed. The people who understood what was happening in Zimbabwe in the early 2000s, they got out or they converted into hard assets. The people who believed it couldn't happen, they lost everything. The pattern repeats throughout history because human nature doesn't change. The psychology is always the same. Normalcy bias, the money illusion, the belief that somehow this time will be different. But this time is not different. This time is following the exact same script that has played out dozens of times before in different countries, different currencies, different circumstances. The details change, but the structure is always the same. Governments overspend. Central banks print money. Currencies debase. Physical assets become the only reliable store of value. The 100 tons of silver sold in India was not an anomaly. It was a warning. It was the system telling you, in the clearest possible terms, that the physical metal is running out and the scramble has begun. The question is not whether you believe this analysis. The question is what you're going to do with the information. Are you going to cling to the illusion and hope that somehow the system holds together despite all the evidence to the contrary? Or are you going to recognize that we've entered a new phase, that the rules have changed, that physical scarcity is asserting itself over financial abstractions? I'm not here to tell you what to do. I'm here to lay out the facts, to give you the framework, to show you what's happening in real time. The silver market is screaming. The backwardation, the lease rates, the premiums, the scrap frenzy, the depleted inventories, these are not subtle signals. These are air raid sirens. And the window for preparation is closing, not in years, not in distant future scenarios, but right now, in the time it takes for the next surge of industrial demand to hit, in the time it takes for the next wave of investors to demand physical delivery, in the time it takes for the mines to fall further behind and the deficit to widen beyond any possibility of recovery. Friends, we've walked through the entire architecture of this crisis, from the paradox hook of prices rising while supply vanishes, to the historical foundation of China's reserve drain, to the mechanical reality of inelastic supply, to the convergence of forces that cannot be stopped. We've seen the evidence, the canaries, the signals that any honest observer must acknowledge. The silver market is not just another commodity going through a price cycle. It is the leading edge of a much larger transformation, a transformation from paper to physical, from illusion to reality, from the assumption of abundance to the recognition of scarcity. What you do with this information is your choice, but understand that doing nothing is also a choice. Believing that the system will somehow fix itself, that new supply will magically appear, that the industrial demand will slow down, that the currency debasement will stop. That is a choice to embrace normalcy bias and hope for the best. The prepared recognize that hope is not a strategy. The prepared understand that when the system shows you what it's capable of, when it reveals its fragility through a 100-ton scrap frenzy, through backwardation, through lease rate spikes, you take that information seriously, you act on it, you step out of the line of fire. The liquidity tide is going out, and we are about to find out who is swimming naked. Make your choice wisely, friends. Thank you for being here today.